Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. I am joined by David Kroll of Mortgage Network, as always, and we are here to discuss all things where your money matters. So to start out with, we wanted to discuss sort of a recap of what's going on with the markets. Basically, we're seeing a continued uptrend, little by little, baby steps up in the U.S. markets. We have been seeing a huge run up in European markets. However, we're looking at perhaps a little bit of increased volatility about to spook us, perhaps for a day, maybe, as we're looking at futures markets down slightly going into the weekend because of some fears of what's going on in China with some regulatory issues that are more complicated to explain than we probably need to today. But by and large,
it's only important to remember that the world is very interconnected.
And some of the reports that we've been reading, of course, are concerns that we might see a little bit of a hiccup in the markets. But when you look at that, you have to consider really if it's a hiccup in the European markets, they have been going gangbusters since the announcement of QE. So a hiccup, somewhat expected, and really, just sort of a bump in the road, most likely. Famous last words. In the U.S., where we only have about a 2% gain for the year, which when you consider it's April, isn't that bad if we see a continuous trend. A little bit of a hiccup might just bring us back to par. But again, the trends seem to be, as we're seeing earnings reports coming out, relatively positive. We're seeing increases in mergers and acquisition activity in a lot of industries. We've seen a couple new IPOs that came out very positively. More than likely, the Fed is not going to increase rates in June. All of these things bode pretty well for U.S. equity markets. So even if there is an increase in volatility, probably a good opportunity to take advantage of it, as opposed to run for the hills and wonder if you should be putting all your money under your mattress. So that's kind of just the basic recap of what's been going on market-wise. We just took all of CNBC, MSNBC, CNN, and everything, Bloomberg, and put it all in one. So there you go.
And the price of money. Same thing. What we've seen is interest rates very resilient. They're at 18-month lows at the moment, and they nudged down just a little bit over the last 4 or 5 days. There's been a very modest bond rally and a slight decline in bond yields over the last 5 days. So yesterday, for a perfect client with perfect credit, we were doing it was possible to get 3.625% fixed rate mortgages, 3.625.
Wow.
Which is really remarkable.
Well, and all your clients are perfect, right?
But
all my clients are perfect.
I love all my clients, but like myself, we are none of us perfect. So most of the clients got 3.75 yesterday. So that's
still ain't bad.
Very, very solid. Nothing looks spooky for the next short term.
And so that's a great segue into what we wanted to discuss on this week's show, and that is really sort of, here we are on Heritage Week. We have a lot of visitors here. Welcome to our island. Thank you very much for coming.
Welcome.
Hopefully the weather stays pretty reasonable or improves from here on out. But we have this beautiful island, and we are so grateful for the opportunity that we have to live here. And we have a lot of people that move in here, and to Bluffton on a daily basis, and that trend is continuing, as you can see with all the building that's going on, especially just off the island, throughout Sea Pines. If you happen to be in Sea Pines, lots and lots of building, remodeling, etc. So we wanted to talk a little bit, and the reason it's a great segue into the cost of money is, as people are looking to retire, and this is one of the places that a lot of folks do look to retire, or pre-retire perhaps, or semi-retire, we wanted to talk about some of those financial factors that might be crossing your mind as you're driving around our beautiful island and thinking, how might we want to eventually someday move into the Hilton Head market or someplace similar. And this is something that David and I encounter on a daily basis with folks that are, on David's side, looking to purchase a home here, a second home here, an eventual primary residence here, and on my side, trying to structure clients' finances so that they can either one, make that happen, or two, plan to make that happen at some point in the future. So I want you to go ahead and kick it off as I finish my monologue here.
No, that's wonderful. It's back to basics first. You are somebody who was born in January of 1946, or at any point from then until 1960, 1961, 1962. So you were born in that 14, 15-year period. So are you out there? That means that today you're somewhere between 55 and 69 years old.
Which
53, 54, and 69 years old.
What do we get? The retirement red zone, I believe somebody has
yes,
determined.
and it also
that is.
happens, guess what, to coincide with the baby boom. So it's normally the retirement red zone for any rolling boxcar of the population. But in this case, the rolling boxcar is the baby boom. So it's very interesting. The first big question becomes, when should I retire? When can I retire? How am I going to have the funds to retire? So we'll sort of pop that one back and forth. I'll lead off with the first element. The first element is that life has changed. We are not our parents. We are not our parents. We live in a different world. We have different aspirations. We have different desires, needs, wants, expectations, and we are in a very different financial condition. When our parents looked forward to retiring, they expected to have Social Security. They expected to get a pension from a job that they'd held for 30 years. They expected to have three sources of two Social Securities and a pension, because the family probably was a single wage earner family, and they expected to be able to live on those three sources of outside income, and they expected to retire at 62, can you believe it? And if they really had to work hard, they retired at 65. That's all changed.
Well, I would say that when folks come into my office and they ask this question, usually they are either they've already made up their mind that they're going to retire, or they are maybe 2 to 3 years from doing so. And the factors that we bring into play always are just going to be your basic financial planning factors. Number one, of course, is what is your current income? What is your future income going to be? Making sure you consider all sources. Also considering if you have assets that you can turn into income-producing assets that may or may not be income-producing right now, whether it's rental property, which could actually be your house in Indiana or Ohio that you might want to rent out for whatever reason. It might be your 401k and other retirement assets that are going to eventually become income producing. So, we sit and we look at all of these different factors, and then we determine based on that, what is life actually going to look like there? How much risk can you actually stomach when we are looking at the type of income that's going to need to be generated to achieve the lifestyle that you want? And then we make decisions based on that. And we frequently, and this is why I think it's such an important topic to discuss with the mortgage broker, frequently families will buy a second home here before they sell their home in DC or Ohio, et cetera. Mm-hmm. And sometimes that can be a real challenge, especially with lending the way that it is today, in terms of, this would be considered, buying a second home would be considered an investment asset, and the terms there are a little bit different. So we frequently interact with mortgage brokers to try to determine how can we best structure our clients' assets for the short term to make sure that they can actually achieve whatever purchase they might want to achieve here with the plan that eventually the other house sells. The other big X factor that we have when we're doing that, however, is what percentage of your overall assets are then going to be tied up in your two homes, what's your cost to carry going to be, and what's the likelihood that that other house is actually going to sell in X period of time. And that's our big unknown. And I am definitely not a real estate expert, and especially not a real estate expert in Ohio. So that is one gigantic factor that we always look at. And I guess
when that weave of variables is difficult is different at every time period. I mean, it's different in 2015, second quarter 2015, than it was in 2014, than it was in 2013. So it's that same mix of variables, but they change over time. The second thing that we find to be remarkable is that the weave of variables is different for each person. Mm-hmm. I mean, it really is a personal financial analysis. Now, this is not to be scary, because it's really not scary. It's not rocket science, but it does require that you sit down with someone in order to have a clear head and a clear strategy, and to be able to move ahead with your retirement plan. Let me give you just a simple example. You can buy on Hilton Head, and one of the reasons that we have 240 condominium associations and something like 22,000 condominium units, in all shapes and sizes, from $50,000 up to $1 million. One of the reasons that the condominiums are so favored here is because they can be short-term rented. And this means that the condominiums up to $350,000, $400,000 in cost actually cash flow on an after-tax basis.
Well, and it really, the utilization of those has definitely increased. So we will be back in 1 second. We have to take a brief commercial break, but please stick with us. We'll be right back with more discussion of ways that perhaps you might make Hilton Head your home. So stick with us. We'll be right back.